I was buying income, but I couldn't move as fast. And I know you've said this on other episodes, like, yeah, it costs more to get in a short-term rental game. Yeah, I get that, but it also gave me more income. So now I'm kind of like, I'm going to diversify my portfolio by taking some of that equity. This still isn't going to be super, super fast to build a big portfolio, but if we can cycle the same dollars every 3 to 6 months and get 2 to 3 properties every 3 to 6 months, we're going to blink and another year and a half is going to go by. Now we're going to own 10 properties or whatever the math works out to be. So I'm pretty excited about that. And I've cycled money. I've cycled money in and out of life insurance policies. So I'm taking that same principle.
How do you find the will to fight back against a world that wants to keep you sedated, average, and stuck in place? Join us for the tools and strategies you need to create a life of abundance, discipline, and high achievement. This is the Tactical Empire with Jeff Smith.
Welcome to the Tactical Empire. I'm here with Sean Ryder again, messing up my intro. So here we are. What's up, Sean?
We need to create a Tactical Empire intro SOP because you and I love SOPs. We do not, but having that nice little transcript. But we're only 100 some episodes in. It might be the first time you mess it up. So good job. Well, what I'm fired up about is this is the first time that your hair is longer than mine on a podcast recording. So you gotta, it's kind of like when your neighbor mows the grass. It's like now the ball's in your court and you got to match it. So I think everyone on my street mowed their lawn this weekend. So we are good. I had the longest one because it was raining and everyone got their mowing in before it rained. And I just did not have the time. So I was like, I need to mow it on whatever morning it was. It's still a little wet. Yeah. Now you need to get your trimmers out and shave that head of yours.
All right. I got you.
We'll do it on this episode. We see how Jeff shaves it. I told my wife because my hair was actually the longest it's been. By long, I mean like maybe like quarter to half an inch last week. And I said, man, this bald spot in the front is really getting thin. And so if it gets any thinner and having it this low, you could still tell that I'm balding. I might have to do the straight razor for the first time in my life. So I said, so you better get on the video. It looks like I don't have any hair, but there is some there. But so I've never done the straight razor. Have you ever done the straight razor shave?
In the military.
Yeah.
Yes.
I think I might have another like few years before I have to get to the straight razor shave because of my balding middle. My dad has a good head of hair, so I don't know why I'm losing all the hair in the front. I think it's because of all the hair gel I used in middle school, probably.
Yeah.
Were you part of the era where we spiked our hair? Were you part of that era back in the early 2000s?
No, I didn't spike my hair.
Bro, I use so much hair gel on my mom's hairspray. It was wild.
It's amazing.
Why did no one tell us not to use that much hair gel and hairspray? The little millennial kids when we were in middle school, we're all balding because we wore hats after we put hair gel. Anyways, that's not what today's episode's for. Jeff, coming out of Birmingham, which we're about a month out. I mean, we had a great meetup there. I know we've had a couple podcast episodes. We've referenced it. You just had Chris Williams on the podcast. He referenced it. He referenced coming out of Birmingham, making the decision to sell one of his short-term rentals. I listened to the episode this morning to tell the audience members, I've actually made the decision to sell one of my 3 short-term rentals. That wasn't a plan that I had going into Birmingham, but coming out of Birmingham, I've changed it. And I changed it for a few reasons. I love my short-term rental portfolio. It's done really well. With this property in particular, it's the least revenue generating, but it's been pretty profitable, and it's actually has the highest occupancy. But we also haven't had a mortgage on the property. We took some capital that we had, rolled it in, and bought this property outright. Have held it for a year and a half. And we've actually been on the course to cash out refi this property. And then coming out of Birmingham, where we kind of talked about adjusting our portfolios, and also with the presentation that you and one of our other Tactical Empire coaches, Justin Harach, gave on the BRRRR method, it got me thinking about deploying that capital into a BRRRR method type portfolio where I am going to partner with someone that has been in that game, understands that game, and I'm going to be the financial partner. So what I realized was instead of getting 75% of the equity out of the property and then diminishing my profit margins, why don't I just capture 100% of that equity with the growth that we've had in the price of the property in a year and a half, take that capital. And you said this on the podcast with Chris Williams. So if you did not listen to the podcast episode with Chris Williams, which is 1 or 2 episodes ago, go back and listen to it. It was, hey, and you said this to Chris, smart move, because if you can capture that equity and then go buy, 3x, 5x the value of the real estate. So like hypothetically, let's say this property is worth 300,000 and that's all in one property. How many properties can I buy with 300,000 doing 20 to 25% down? Now you're looking at over $1 million worth of top line value of real estate. So this is, Jeff, I'm going to challenge you. I want this to be one of the shortest episodes, not only in Tactical Empire history, but podcast history, specifically on the math behind a BRRRR, BRRRR, buy, rehab, rent, refinance, and repeat BRRRR method, long-term rental investment, exactly how you and Justin presented it to us in Birmingham.
Well, your offer price is 70% of ARV minus your repair costs that are necessary. And what you would do is you have to buy it at that price. Then you go in and you rehab it and then rent it, refinance it, and repeat it and capture the equity. So that 30% delta that you're building in on the front end should be your bottom line if your ARV hits. Like, obviously that gives you wiggle room to go over budget with rehab and to miss the mark slightly on the ARV, because appraisals are coming in shit right now. If you're not active in the market, appraisals are down tremendously. I could tell you a variety of reasons on why that is, but that's both in the commercial space and the residential space. They're 3 times the price that they were 3 years ago, and they are 30% less than you think they're going to come in at. So, but that said, it gives you a little bit of wiggle room, but that's your bottom line equity capture on the way in for doing the work. So let's say you buy a $200,000 house, you're going to gain $60,000 of equity if you do it exactly spot on the numbers, and you come in with that level of equity, and that goes straight to your bottom line, your net worth, and your balance sheet, right? So you're gaining $60,000 on that deal. You presumably don't have to use any of your own money, because you can do it with hard money or you can do it with private money. And that's a repeatable process that you can do over and over again to build your net worth, to build your amount of rental properties, and then you roll. Well, it depends on what your goals are. But yeah, I don't know where you wanted me to take that, but that's the standard calculation: 70% of after repaired value, which is what it's going to appraise at when you do the upgrades and repairs that you're going to do to it. And then you back out your repair costs from there.
Yeah, what I really liked when you guys presented in Birmingham was, like, one, we had a whiteboard, so saying numbers was a little bit easier to say. Sure. So I apologize for the people listening to audio only, but you guys basically came in and was like, hey, if we could buy a property for 80 grand, and maybe it's worth a little bit more than that, but we're going to pay 80 grand cash for a property. We're going to put 40 into it. Now you're $120,000 into a home. And for those listening, this blows my mind, because in Winchester, Virginia, you're not buying anything. You're not even buying a doghouse for $80,000. But you can still buy homes in the United States in places for 80 grand. I had to wrap my mind around that for the longest time. But you buy a property for 80 grand cash, you put 40 grand cash into the value, or increasing, rehabbing the property, making sure that all the things are taken care of. Now you're 120 into the deal, and then you go put a renter in it and you go get an appraisal, and that appraisal comes back at 150. So you're 120 in, it appraised at 150. If you can get 80% loan to value loan, now you can get all 120,000 of your dollars back on a cash out refi. That property is now going to be mortgaged at $800 to $900 a month, and you can rent it for $1,350 to $1,450 a month. So you're getting your money back, you're getting monthly cash flow, and you're getting appreciation and the depreciation on your taxes. And so seeing it that way, if you listen to other podcast episodes, it was like, hey, like, I'm not, especially when I started getting into the short-term rental game, like, I was buying income. I needed to buy income at that time. This was coming out of COVID. And so I needed more cash flow. So that's why I went the short-term game. It was like, man, I can't take a year and a half to start buying these properties for $200, $300. cash flow a month. And so that's something that I had to wrap my mind around in regards to, okay, but you're going to be able to move faster because you're going to get all your money back out. Because when I was buying short-term rentals, I was putting money in, but I wasn't getting that money back out. And so that was the difference. I was buying income, but I couldn't move as fast. And I know you've said this on other episodes, like, yeah, it costs more to get in a short-term rental game. Yeah, I get that, but it also gave me more income. So now I'm kind of like, I'm going to diversify my portfolio by taking some of that equity. This still isn't going to be super, super fast to build a big portfolio, but if we can cycle the same dollars every 3 to 6 months and get 2 to 3 properties every 3 to 6 months, we're going to blink and another year and a half is going to go by. Now we're going to own 10 properties or whatever the math works out to be. So I'm pretty excited about that. And I've cycled money. I've cycled money in and out of life insurance policies. So I'm taking that same principle and now I'm just going to cycle it using, actual real estate. So it was just the same principles that I use, just a slightly different angle to view the investment side of it from.
Yeah. And I'm sorry I never explained it that well before Birmingham, I guess, because that's exactly the name of the game. One thing I would correct you on is you would need it like a $160,000 appraisal to get all your money back because you've got closing costs. So,
yes.
I don't want to gloss over that. So you'd need to get a 160 appraisal to get all your actual money back. But because there's fees and closing costs, and you're probably going to double close in that situation, which is going to cost you $3,500 on each end. So another $7,000 would be loaded up. So you'd leave that with a $127,000 mortgage. So I'm not going to get too mathy because we don't have a whiteboard, and
no, that was good.
Not good content for a podcast. But to your point, that's exactly how I would use the infinite banking system. That's exactly how I did use the infinite banking system. And so to that $120,000 that you used on the front end, if you had all that cash, you don't even need all that cash. And I can teach you other ways to do it without all that cash. But if you have all that cash, you can put it out exactly like you're talking about. It's going to be tied up for 3 to 4 months. And in the scenario that we just said, you're going to make a 160 appraisal to a $127,000 mortgage. You're going to make $33,000. Okay. So in 3 months, you're going to take $120,000. You're going to get your 120 back. You're going to make $33,000 to your bottom line of your net worth, right? And you've got a property that cash flows somewhere between $300 and $600 a month. Okay. It's not sexy. It's not $1 million by any means, but you've made $33,000, which is a 27% return on your $120,000 in 3 fucking months. Okay. And you've got an asset. Do that 4 times a year. You've now made $140,000 to your bottom line in year 1. Mind you, this thing snowballs and starts to move with more and more momentum as you do it over time. And let's say you do 4 of them in the first year, you're going to make $142,000 in cash to your net worth, your balance sheet, right? It's not realized, but at the end of the day, you'll be making, let's call it, we'll conservatively say $300 a month on the houses. And so you're making $1,200 a month net, and which is what, $14,000 a year, something like that. $14,000, you've increased your cash flow, and you've put $140,000 on your balance sheet. So that's not a bad year, no matter how you look at it. And so if you make partnerships with 5 guys doing this at the same time, right? So you got 5 operators out there doing that. You're adding $700,000 to your balance sheet. You're adding $8,600 of cash flow a month by the end of the year with 5 operators. Now your balance sheet would be split in half if you guys were 50-50 equity guys. So let's say you add 350, still not bad, right? Cash flow, maybe you add 4,300 instead of 8,600, but still not bad. What's that? $50,000 a year that you've increased your income now by $50,000. You've increased your balance sheet by a couple $100,000. And all you have to do is be lendable, because you don't even have to do this with your $120,000. Because when I say, hey, if you do 5 partners, you're like, whoa, fuck, that's $600,000 in cash. I don't have that available. But you can do this with hard money, or you can go out and get other lenders to do it and lend the money to you
Right.
to do it.
Well, you apologize, said that's, if you haven't ever explained it, you've been explaining real estate the same way to me from the beginning. So it wasn't that your message needed to change. It was my position was completely different 2 years ago, right? I owned an active business coming out of COVID where my income was cut, but I had capital. So I was trying to buy income as fast as possible. So buying buying 2 already operational Airbnbs that could net thousands of dollars a month. That's the headspace I was in.
Yep.
And by the way, guys, I'm only selling 1 of my 3 short-term rentals. I'm still high on the short-term rental game for the properties that I own and how I invest in them, especially using the infinite banking concept. They net really good margins. But now that things have shifted and my family has re-solidified our income from numerous streams, now this method is highly attractive to me, especially because I'm going from being an active, involved owner in the STRs, even though I have property management, to being the financial partner in this BRRRR portfolio. So I will be 100% hands off on all that stuff. So again, it's just kind of like the lesson that I learned in Birmingham was like, it's okay to adjust your investment portfolio and take your gains, right? Like I do have gains on these properties. I've made income from them and they've gone up in value. So it's okay to liquidate that asset as long as you're staying in the game, right? If I liquidated that asset, put that money back in a bank account and sat for the next 3 years, that could be a mistake.
Yeah, for sure.
But don't ever feel bad for capturing equity. That was a lesson that I learned in Birmingham. And I'm perfectly okay with telling people that I'm selling a short-term rental to capture that equity.
Yep, it's good. I'm excited for you, bro. It's a smart move. And like I said, you're just changing your perspective because your return on your time is infinite in that model. And so there's nothing stopping you. When I use the example of go make 5 partners to do that, there's nothing stopping you with making 50 partners to do that. So when you talk about your limitation is finding operators to partner with or scaling with your partner in the operation there, right? That's your only limitation at that point because you're not trading dollars for hours. It's a passive investment for you. So it doesn't hurt for you to sit and wait because if that $1,200 a month turns into $12,000 a month, will eventually turn into $120,000 a month, and time's going to go by either way. So for you spend time on things you enjoy and just keep looking for these strategic opportunities as long as they meet your criteria of like, I do not go in and muck with the operations.
It's time to implement the real life game of Monopoly, ladies and gentlemen. Monopoly and Cash Flow by Robert Kiyosaki. So no, I wanted people to kind of hear, 1, the math behind the BRRRR method that we presented in Birmingham. And then 2, just let them know that, I've made changes. Chris Williams disclosed on his podcast recording that he's making changes and that is 100% okay. But the common denominator between those 2 people and just me making moves is Jeff Smith. So Jeff, I appreciate your insight and your mentorship over the years. And it's cool. It's cool to step back and see my perspective change. So I appreciate those words of wisdom. And it'll be cool to record an episode 6 months from now and 12 months from now when we have a couple of these properties in Texas and the southern states where you can buy houses for 2 boxes of Ritz crackers.
Well, I'm looking forward to you guys making life-changing moves, and it's you guys taking action, and so it's going to be fun to watch. So
appreciate it.
All right, folks, join us in the Tactical Empire community on Facebook. Hit us up, DM us if you have any questions. Share this episode if you think it was helpful or you know anybody that wants to get into real estate or infinite banking. Send them our way. We can explain it to them. We've got resources and everything else. So touch base with us if you have any questions. Have a great week and kick ass.